Special coverage from the Deutsche Goldmesse is brought to you by First Majestic Silver. There's no substitute for silver. Hello and welcome back to Frankfurt. Welcome back to the Deutsche Goldmesse and welcome back to the Soar Financial YouTube channel. My name is Kai Hoffmann. I'm the @JR Mining guy on X. And of course, you're a host of this channel. And I'm really excited to welcome one of our keynotes here in Frankfurt, Alex Krainer. One of my favorite geopolitical commentators. Alex, it's so great to have you here in Frankfurt. Thank you so much for joining us.
Thank you. It's a pleasure. A very good conference. I'm enjoying it, so it's good to be here.
I really appreciate it. It's, keynotes like you make it really worth it and really add a lot of extra value to our audience as well. Why do commodity prices matter? It was sort of the title of your presentation, and let's dissect that a little bit. So it's an interesting topic. Which angle should we approach it from?
Well, you see, this is something we could talk about for many hours. So it's very hard to condense it in like a bumper sticker thing. But I put a word play on my keynote. Commodity prices matter because Black Lives Matter has been like a popular slogan lately. But basically, this is something that I've been that's been like a focal point of my professional career for probably the last 30 years. When I started working in oil trading, my job actually became fixing the risk to our group from exposure to oil prices. So as I dove deeper and deeper into it, I realized, well, not only is this a risk, the whole business revolves around the price. This is something that in the professional life, many people either don't recognize, and some of them will just they reject it, and they think like, no, we do operations, we mine, we transport oil, we extract oil, and we sell it, we make our margin, and that's that. But the more you explore the subject, the more you realize that actually the price is everything. Let's say 2 years ago you could have sold an ounce of gold for about $2,000. Today it's over $4,000. It's not at all the same. And if you look at the financial news, you find that sometimes companies sustain multi-billion-dollar losses because they sold their production in advance at a low price, and then as the price went in their favor, they couldn't benefit from it. Or conversely, they are not hedged at all, right? And then when the price corrects, and in commodity markets, a correction of 20, 30, even 50% happens very regularly. So then they sustain multi-billion-dollar losses because they didn't hedge their exposure. So, managing the risk from price exposure can literally make or break a business. And it does. It regularly does. So that is a message that I've been trying to convey both to investors and to the industry, because it's a problem matter that's, let's say, it's complex to solve, but it can be solved, at least to the extent that you're making yourself more resilient, less vulnerable to severe risk events, and then you can give your business extra longevity and even a difficult to copy competitive advantage over your rivals. So that is really. I think I won't exaggerate if I say it's the most important thing to focus on, especially for commodity-related businesses.
It's interesting because you brought us a couple examples, like Anglo Gold Ashanti. They had a terrible price hedge, or would you call it a collar? Or so they have forward sold gold at $450 an ounce, and they made huge losses because gold price ran.
Correct.
And they lost like $2.4 billion. I have the presentation here in front of me. That's massive. Like,
that's huge.
Should companies in general be hedged? Like, let's take it very theoretical. Like, let's take it a step back. Actually, should they use hedges at all?
Well, okay. So that's the whole thing. Should companies hedge or should they not hedge? That's like the crudest approach to it, where you have to answer that question either or. In most cases, by far, the management in such companies makes this kind of a crude thing. And we've seen some of them in this conference where they say, "Oh, we're not hedged at all." Now they look very smart because the prices of gold and silver have gone their way, and so they've benefited from that. But then you have you mentioned Anglo Gold Ashanti. The following year, gold made a correction of $500 per ounce from $1,700 to $1,200, and Barrick Gold lost $8.6 billion in one quarter because they didn't hedge. So up until that correction, they looked very smart, and then they looked very stupid the next quarter. So that happens all the time. And I think that the proper question should be, hey, why don't we hedge when prices are moving against us, but we hedge when they're going in our favor? No, we don't hedge when they're going in our favor. We do hedge when they're going against us. Now, at this stage, everybody will say, well, you're talking nonsense because this can't be done. This is like you're talking magic, right? It's not exactly like that. So you can do it. You just have to take a very systematic approach to risk management. And you have to recognize that, if you run an operative business, you're a miner, you're an oil producer or any type of commodity, basically the company will select for skills that serve the operating business. So it'll be production, marketing, some form of engineering, finance, these type of things. When we're talking about hedging, you're usually talking about speculation, which unfortunately is inevitable. And operative companies do not cultivate these types of skills. So you have to really take focus on this problem matter and then practically design a business process to incorporate with the rest of your operations that will basically try to reduce the risk from exposure to oil price. Not in a sense, it's not magic, but basically so here's a few simple facts. Far and away the biggest risk to your business if you're in commodities is the risk of extreme price events. Okay, so that's normal, everybody can see that. Second thing to recognize is that extreme risk events do not happen overnight. Invariably, they span a period of, let's say, a few weeks or a few months or sometimes even a few years. When you see the price of oil going up and silver, you see that it's been happening for over a span of years. These extreme price events always manifest as trends. And so if you apply systematic trend following to your hedging, then you can basically identify periods of time when the prices are going in your favor, and then depending on your risk appetite, you can decide, okay, we're going to underhedge until we read that the trend has reversed. And then or you might decide to not hedge at all. Yeah. And then when the price starts moving against you, of course, you're not going to identify that at the very peak, but at some point after that, at that point, you can begin to hedge a portion of your production or all of your production. And so in that way, over, let's say, long stretches of time, you can actually gain an advantage that's based strictly on the movements of the price of your commodity.
Let's look at the gold price today. Like we're at 4,100 roughly, but we were at 4,400 as well. So how do you trade or how do you hedge around those? Like how do you factor that in? Like the trend is probably still intact.
Yes.
Right. But you have these massive, like this price spike, for example. How do you account for that?
Well, okay. So obviously, you wouldn't be able to trade it so that you lock in the 4,400, the peak price. But let's say you could recognize that the price is in an uptrend. So at that point, you can say, okay, this is if you're a gold producer, you say, this is working in our favor. Let's keep at least a portion of our production unhedged because it's good for our top line. And you will be able to recognize a reversal of that trend at some point, which is not going to be at the top. But usually trend reversals span also a space of a couple of weeks. So you'll get, on the chart, you get a peak, and then a correction. And then maybe the next peak, if it's lower than the previous peak, it tells you that the buying pressure is no longer there. And then if the next correction goes lower than the previous trough, then you see like, okay, this market may be ready to reverse. And at that point, you might make a decision, okay, let's now hedge a chunk of our production because maybe this is going to be low. And usually when commodities markets go into substantial corrections, those can last a long time. So it can be 2 years, it can be 3 years. But usually when that happens, you're not going to go to the next peak immediately. So it's safe to assume that for a period of time, hedging a part of your production is a better bet than leaving it all unhedged.
So applying that to the gold price today, should we stay unhedged or should we start hedging now?
Let's say that at the moment you would still want to be unhedged because the trend is intact.
Okay.
And it only depends on, so now we've seen a correction from 4,400 went to about 3980
or something.
Yeah, like something like that. Then it went back up to 4,200. Now we're back it's going back down. But we have to see, because
the chart pattern, sorry to jump in, but the chart pattern you just mapped out explaining the previous point, that reminded me of what I'm looking at in the gold price chart today. That's why I was asking.
But at this point, it may not be a reversal. It may be only a consolidation. So, you might get like a price consolidation to pick up into the next leg of the bull market. So you wouldn't want to go hedge yourself for a long chunk of time at these levels. But let's say if this consolidation turns out to be a correction or a bear market for a year or 2 or 3, then at that point you might want to start putting in your hedges. You're not going to sell your production at 4,400.
No.
You have to make peace with that. But if you've locked in 4,000 or 3,800 or something at these levels, if the price ends up going much, much lower, you've done a good thing. Yeah,
100%. Let's see if we can combine geopolitics a little bit with commodity prices. Because how much can we use commodity prices, gold, oil in particular, for forecasting geopolitical events and other things as well?
I think you can, but only in terms of very long-term cycles. If you look at the geopolitical equation today in the world and you determine that we're probably going into some kind of an escalation of global conflicts, then it's justified to come to the conclusion that prices of gold and silver are probably going to go much, much higher in the future. But the nature of commodity markets is such that they can, in the short term, and the short term could be a year or 2 or 3, they might even have a very substantial correction. So we've seen that, when the crude oil was already in an uptrend of sorts, we've seen easily corrections of 30, 40, 50%. And then you have events like in 2020 we had the pandemic, and the oil price crashed by 76%. Well, reportedly it went negative, so that percentages become meaningless. All the commodities had a very, very brutal correction, and so these are events that you cannot predict.
Yeah.
But even then, again, like if you look at the price charts of all this, you see that the correction occurred over a period of 2 or 3 months. It didn't happen overnight.
Yeah.
So usually you can recognize that, and if you apply certain, let's say, trend-following methods to it, you will be able to catch the move and adjust your exposure accordingly.
What are some of the most exciting trends you're following right now that excite you personally, away from gold and silver and maybe oil? Unless they, of course, are the most exciting trends for you right now. But
okay, so in addition to gold and silver, which are definitely in really nice bull trends at the moment, I am anticipating a very powerful bear market trend for European bonds. Gilts, Euro bonds, maybe to a lesser extent American bonds, but basically most, if not all, of the Western powers' government bonds. So I think that we've already had what they call the bonds Armageddon. Yeah, I think the Zero Hedge labeled it bonds Armageddon, that went from 2021 until 2023, more or less, where you had a huge correction in bond prices. In fact, on the American bond market, it was the biggest correction in 236 years of price history that we have. This has consolidated now over the last 2 years or so. Prices have been fluctuating almost horizontally, but there's no buying power and there's no good news on the horizon. So I expect, European bonds, the Bund, German Bund, they're already looking very bearish. So does Gilt, the British government bonds. American bonds appear to have reversed the bear market a little bit, so they're heading higher at the moment. But I think that over the next couple of years, we might see a very brutal bear market in bonds, and then by extension in the currencies, the euro, the pound, Canadian dollar, Japanese yen. So I think that all of those currencies are going to see very, very substantial losses. And then when you put geopolitics into that mix, and then you ask yourself how big can this event be? I think it can be as big as the collapse of the Weimar Republic in 1922, 23. And at that point, we saw the German imperial bond practically go to zero. So I think that one of the themes for investors to explore today could be shorting the sovereign bonds.
All duration bonds? Is there an indicator?
I would say the longer term.
The longer term?
Yeah, the longer term particularly, yes.
That's an interesting...
Because the longer term you go, the more volatile you are. So you get the bigger. And then, when crisis hit, governments tend to shift their finances to short-term debt.
That's what the U.S. is doing.
Exactly.
It's pretty much exclusively these days. You didn't mention the U.S. dollar when you mentioned the currencies that might get debased. The euro, Canadian dollar.
I think the dollar is in the same basket, but I think the United States have a much better maneuvering space to handle the crisis. We see that the Trump administration has designs on Canada, on Greenland. It looks like Venezuela is in the crosshairs as well. Only I can't tell whether Trump's big show around Venezuela is fake or genuine, because we saw the same thing with Iran. We had the big gathering of forces, making it look like they were going to go for a regime change war against Iran, and then nothing happened. And now we're seeing the same thing with Venezuela. Why am I saying this? Because Venezuela was never on the radar. So in the campaign discussions, there was Trump was open about Canada. He was open about Greenland. He was never open about Venezuela. In fact, he wasn't even on the radar. So the fact that they're all of a sudden doing this, because it came just out of nowhere, makes me suspect that maybe it's like a dog and pony show, like with Iran, that they will maybe they're distracting attention away from something else, maybe who knows what, but I'll believe it when I see it. And I think that the risk of the United States going to war against Venezuela is extremely high, in the sense the risk of adverse outcomes of the war. Because Venezuela would be very difficult terrain for U.S. military. You would need not 10, 20,000 troops. You would probably need 500,000. It's a tropical country. It could become another Vietnam for the United States. And on the other hand, I think that places like Canada and Greenland could be had without a shot being fired, just through political maneuvers against Canadian government, against the British government, and so forth. and I know that they are already doing this. We can't say how successful they will be and how soon. So we'll see. Anyway, if you if you bring those countries under your control politically,
No.
Canada, Greenland, then you own the collateral in form of their natural resource wealth, their labor power, and so forth, and thereby you're relieving the pressure from the overhang of bad debts in your economy because you brought new wealth into the system. So from that standpoint, I think the United States is in a better position to manage the crisis than is the United Kingdom, Japan, or European powers. And so I'm not putting any ethical, I'm just stating the facts as I perceive them.
Maybe one last follow-up to that topic. So you touched on it yesterday a little bit as well. It's just the topic of AI. And it feels like the U.S. is an AI superpower. Maybe China's got a say in that as well. But those are on top of mind, maybe the only AI superpowers right now. Is the AI and maybe tech supremacy also supporting the role of the U.S. dollar on a global basis?
I'm not sure if that supremacy is real or perceived. As everything in the United States, there's a lot of show on the facade, and then you have to ask yourself what's in the back. I think that with AI right now, it appears that the whole theme is a little bit unsustainable. It appears that way because they invested extremely heavily. You have OpenAI, which is buying huge quantities of chips with money they don't have. And so, it's like the shop is lending money to the client in order to boost their own sales. So we see NVIDIA buying $100 million of...
But that's what furniture stores do. Car manufacturers do that as well.
Yeah, exactly. But all of that can work so long as the credit cycle is expanding, and then, the tide is rising and it lifts all the boats. But, if the tide pulls away, there's going to be a lot of stranded boats. And I think that AI is going to be one of the first ones of them. And then you also have the problem of energy, because these things are draining a lot of energy from the system. And the United States will have to invest heavily in electricity generation. And they're behind that. And they're particularly far behind that with respect to countries like Russia and China. Mm-hmm. And the Chinese nuclear power plants generate electricity that's about 80% cheaper than the American-built power plants. So they're not competitive. And so we've already seen that Chinese AI companies can underprice American ones by a huge margin, and they're very successful. And their AI, I've tested some of their AI, and it's actually very good. I can't say that American AI is better. It's, at least I cannot see that. And in many ways, even in people who use AI for coding, now new Chinese coding agents are just as good as the American one, and they cost next to nothing.
It's an interesting development for sure. Alex, we got to put a bow around this. Unfortunately, I could chat with you for hours. You got so many interesting angles to explore. Really appreciate you joining us here in Frankfurt.
Thank you very much. It's a pleasure. I'm really enjoying the conference, and congratulations. You've done a great job organizing it.
Thank you.
And so if there's occasion to do this again in the future, I absolutely match for it.
We'll have to do a geopolitical outlook 2026.
Oh, absolutely.
At some point. Right?
Absolutely. Well, I have a book coming out on Ukraine war, and then that's gonna give us some food for thought as well.
What's the release date?
Yes.
What's the date? Yes. Awesome. Okay. No, really appreciate it. We'll definitely. We'll get you back on for that as well, but maybe we'll do a geopolitical outlook 2026. I'd like that, maybe in early January. Yes. That'd be fantastic.
Oh yeah, absolutely.
So, Alex, thank you so much for joining us. Really appreciate it. Everybody else, thanks so much for tuning in. Hope you enjoyed this show here from the floor of the Frankfurt Deutsche Goldmesse. Much appreciate you tuning in. I tremendously appreciate my guests here. They made all the effort to come out here, and it means a lot to us. If you enjoyed this conversation, hit that like button, and maybe join us in Frankfurt as well. I'm meeting quite a few of you here at this conference. So thanks so much for tuning in, and take care out there.